A crash is coming. I do not know exactly when. I do not know exactly what will trigger it. But I know the conditions are in place for a significant market downturn, and I know most investors are completely unprepared for what happens next. But here is what separates successful investors from everyone else. They do not just prepare for crashes, they position themselves to profit from them. They understand that crashes are not just periods of destruction. They are periods of tremendous wealth transfer. Money flows from the unprepared to the prepared, from the panic to the patient, from those who sell at the bottom to those who buy at the bottom. I have spent my career studying market crashes. I made my reputation and my fortune by identifying the housing bubble before it burst and positioning accordingly. And I have spent years analyzing what happens after crashes, which sectors recover first, which sectors surge to new highs, which sectors generate the greatest returns for investors who have the courage to buy when everyone else is selling. Today I am going to share the 3 sectors that I believe will explode after the coming crash. These are not random guesses. These are conclusions drawn from studying every major market crash over the past century, from analyzing the economic conditions that follow downturns, from understanding how capital flows when fear gives way to opportunity. If you position yourself correctly before the crash, you will not just survive what is coming. You will thrive. You will build wealth, while others are recovering from losses. You will be years ahead of investors who are too scared to act when opportunities appear. But first, let me explain why I am confident a crash is coming and what it will likely look like. Because understanding the nature of the coming downturn is essential to positioning for its aftermath. The signs are everywhere if you know where to look. Valuations in many parts of the market are stretched to levels that historically precede major corrections. Debt levels across the economy, government debt, corporate debt, consumer debt are at record highs. The Federal Reserve has painted itself into a corner, unable to cut rates aggressively without reigniting inflation, unable to raise rates further without triggering a recession. Geopolitical tensions are elevated. The commercial real estate market is showing serious stress. Regional banks are sitting on unrealized losses that could become very real if conditions deteriorate. I am not predicting the end of the world. I am not saying the financial system will collapse. What I am saying is that we are due for a significant correction, a 20 to 40% decline in major indices, a period of fear and panic where prices fall far below intrinsic value, a classic market crash followed by a classic recovery. And it is the recovery that I want to focus on today, because the recovery is where fortunes are made. The crash itself is just the setup. The real opportunity comes when the crash ends and certain sectors begin their explosive moves higher. The first sector that will explode after the crash is energy, and I am not just talking about oil and gas stocks, though those will certainly participate. I am talking about the entire energy complex, traditional hydrocarbons, pipelines, and infrastructure, utilities, and yes, certain renewable energy companies that have been left for dead. Let me explain why energy always leads coming out of crashes. Economic crashes destroy demand temporarily, factories slow production, consumers cut spending, transportation decreases, energy consumption falls. This causes energy prices to collapse during the crash itself. Oil goes from $80 to $40. Natural gas prices crater. Energy stocks fall even faster than the broader market because investors extrapolate the demand destruction into the future. But here is what they miss. Energy demand is essential. It is not discretionary. When the economy recovers, and it always recovers, energy demand comes roaring back. Factories restart, consumers resume driving and flying, economic activity requires energy. There is no recovery without increased energy consumption. And here is the critical insight. While demand is collapsing during the crash, supply is also being destroyed. Energy companies cut capital expenditures. They cancel drilling programs, they delay infrastructure projects, they lay off workers, the industry shrinks dramatically to survive the downturn. This sets up a supply squeeze when demand recovers. Demand comes back quickly because it is tied to economic activity. Supply comes back slowly because it takes years to restart drilling programs, to hire and train workers, to build infrastructure. The result is a period of tight supply and rising prices that generates enormous profits for energy companies. We saw this pattern after the 2008 financial crisis. Oil crashed from $147 to $33 during the crisis. Energy stocks were decimated. Everyone assumed oil would stay cheap forever, and then demand recovered while supply remained constrained. Oil prices rose steadily, eventually exceeding $100 again. Energy stocks generated massive returns for investors who bought during the panic. We saw it again after the 2020 pandemic crash. Oil briefly went negative. Energy stocks fell 80 or 90%. The industry was written off as dead, and then demand came roaring back while years of underinvestment and supply created shortages. Energy became the best performing sector for the next 2 years. The same pattern will repeat after the coming crash. Energy demand will fall temporarily. Prices will collapse, stocks will crater. Everyone will declare the end of fossil fuels, and then demand will recover, supply will be constrained, and energy stocks will generate spectacular returns. But I want to be specific about which energy investments I find most attractive. First, integrated oil majors with strong balance sheets. These are companies that can survive the crash without going bankrupt, that have the scale and financial resources to acquire distressed assets during the downturn. And that will benefit enormously when prices recover. Look for companies with low debt, diversified operations, and histories of maintaining dividends through downturns. Second, pipeline and infrastructure companies. These businesses collect fees for transporting energy regardless of commodity prices. They are more stable than exploration and production companies. And they trade at attractive yields that become even more attractive during market panics. The infrastructure is essential. It does not become less essential during a crash. But the stock prices fall anyway, because investors sell everything indiscriminately. Third, and this may surprise you, certain renewable energy companies. The crash will devastate the renewable sector. Many companies are highly leveraged. Many are unprofitable. Many depend on access to capital markets that will freeze during a crisis. The weak companies will fail, but the strong ones will survive and will be positioned to dominate a sector with powerful long-term tailwinds. Buying quality renewable companies at distressed prices could generate enormous returns as the energy transition continues over the coming decades. The key with energy is patience and selectivity. Do not buy the most leveraged or speculative companies. They may not survive the crash. Buy quality companies at distressed prices and hold them through the recovery. The returns will be substantial. The second sector that will explode after the crash is financials, banks, insurance companies, asset managers, and specialty finance companies. This sector gets destroyed during every crash and then generates enormous returns during the recovery. I know what you are thinking. Banks are at the center of every crisis. They caused the 2008 crash. They are the riskiest part of the market. Why would anyone want to own them? Here is why. Banks are leveraged to economic activity. When the economy contracts, loan losses rise, trading revenue falls, deal flow stops, and bank earnings collapse. This is why bank stocks fall so dramatically during crashes, often 50 or 60 or 70% from peak to trough. But that leverage works both ways. When the economy recovers, loan losses normalize, trading activity resumes, deals restart, and bank earnings explode higher. The same leverage that crushes earnings during the crash magnifies earnings during the recovery. Moreover, crashes clean out the weak players. The banks that took too much risk, that had inadequate capital, that made bad loans. They fail or get acquired during the crash. The survivors emerge stronger. They gain market share. They acquire distressed assets at attractive prices. They benefit from reduced competition. Think about what happened after 2008. Many banks failed or were acquired, but the banks that survived generated enormous returns over the following decade. JP Morgan, Bank of America, Wells Fargo. Their stocks fell 80 or 90% during the crisis, and then they rose 500 or 1,000% over the next 10 years. Investors who bought bank stocks at the bottom of the financial crisis made fortunes. The same pattern played out after 2020. Bank stocks collapsed as investors feared a wave of loan defaults from pandemic shutdowns. And then the defaults never materialized at the scale expected. The economy recovered faster than anticipated, and bank stocks more than tripled from their lows. Now, I am not suggesting you buy banks blindly. The sector is not homogeneous. Some banks are well managed with conservative lending standards and strong capital positions. Others are accidents waiting to happen during the crash. You want to buy the survivors, not the casualties. Here is how I think about identifying the survivors. Look for banks with high levels of capital relative to assets. Look for banks with diversified revenue streams, not just lending but also wealth management, trading, and fee-based services. Look for banks with conservative loan portfolios, limited exposure to commercial real estate and other stress sectors. Look for banks with strong deposit franchises that provide stable, low-cost funding. The regional bank sector is particularly interesting right now. These banks have been crushed by fears of deposit flight and commercial real estate losses. Many are trading at significant discounts to tangible book value. Some of these fears are justified, and some regional banks will fail or be acquired during the coming crash. But others are being painted with too broad a brush. Quality regional banks with strong deposit bases and conservative lending will survive and thrive. Insurance companies are another attractive subsector. Property and casualty insurers benefit from rising premiums after periods of losses. Life insurers benefit from higher interest rates, which increase investment income. Both tend to be conservatively managed with strong balance sheets, and both get unfairly punished during market panics when investors sell everything financial. Asset managers are a third attractive subsector. These businesses earn fees on assets under management. During crashes, asset values fall and so do fee revenues. But when markets recover, assets under management grow from both market appreciation and new client inflows. The operating leverage in these businesses is enormous. A 50% increase in assets under management flows almost entirely to the bottom line. The financial sector will be ground zero during the coming crash. Stocks will fall dramatically. Headlines will scream about bank failures and systemic risk. It will feel like 2008 all over again. And that is exactly when you want to be buying, because the recovery in financial stocks will be explosive. The third sector that will explode after the crash is consumer discretionary. Specifically, the retailers, restaurants, travel companies, and entertainment businesses that get destroyed during economic downturns and then surge when consumer confidence returns. This sector is the most hated during crashes. Consumer discretionary companies see revenues collapse as households cut spending on non-essential items, restaurants empty out, retail stores see traffic disappear, travel bookings cancel, entertainment venues close. The stocks fall 70 or 80% as investors price in bankruptcy for many companies. And yes, some companies do go bankrupt, the weakest players with too much debt, undifferentiated products, and poor management do not survive. But the survivors emerge into a dramatically improved competitive landscape. Their weaker competitors are gone. Market share is available for the taking and pent-up consumer demand is waiting to be unleashed. Here is what most people do not understand about consumer behavior during and after crashes. Consumers do not stop wanting things during recessions. They stop buying things because they are scared about their jobs and their finances. But the desire does not go away. It builds up, it becomes pent-up demand. When the recession ends, when jobs start growing again, when consumer confidence returns, that pent-up demand gets unleashed. People buy the cars they delayed purchasing. They take the vacations they postponed. They eat at the restaurants they avoided. They buy the clothes and electronics and furniture they put off buying. Consumer spending surges. The companies that survived the crash are positioned to capture this surge. They have less competition. They often acquired distressed assets at attractive prices during the crash. They have lean cost structures from the cuts they made to survive, and they have operating leverage that converts revenue growth into profit growth at an accelerating rate. After the 2008 crisis, consumer discretionary was the best performing sector for years. Retailers like Amazon and Home Depot generated enormous returns. Restaurant chains that survived saw their stocks multiply. Travel companies like Booking Holdings and Marriott generated 500% or more returns from their crisis lows. After the 2020 crash, the pattern repeated even more dramatically. Consumer discretionary stocks were among the best performers as stimulus checks and pent-up demand created a spending surge. Even beaten-down retailers and restaurants saw their stocks rise 300 or 400 or 500% from pandemic lows. The key is identifying which companies will survive the crash and emerge stronger. Here is what I look for: strong balance sheets with manageable debt levels. Companies drowning in debt do not survive crashes. They either go bankrupt or have to dilute shareholders massively to stay alive. Either way, equity investors lose. Look for companies that entered the crash with conservative capital structures. Essential or differentiated products. Companies selling commoditized products that consumers can easily substitute face brutal competition during downturns. Companies with brand loyalty, unique offerings, or essential products maintain pricing power and customer relationships even when spending falls. Variable cost structures that allow rapid adjustment. Companies with high fixed costs cannot cut expenses fast enough when revenues fall. They lose money throughout the downturn and emerge weakened. Companies with variable costs can right-size quickly and maintain profitability even at lower revenue levels. Experienced management teams that have navigated previous downturns. Crisis management is a skill. Leaders who have survived previous crashes know how to make the tough decisions quickly, how to maintain employee morale, how to preserve customer relationships, and how to position for recovery. When I look at the consumer discretionary sector today, I see many companies trading at valuations that already reflect a significant downturn. The market is anticipating a recession and has marked down consumer stocks accordingly. This means the further downside during the actual crash may be more limited than in previous cycles, and it means the upside during the recovery could come faster and larger. Now let me bring this all together and talk about how to actually position a portfolio for the post-crash explosion. First, you need to survive the crash itself. This means having cash available. It means avoiding leverage. It means owning quality assets that will not go to zero, even in severe downturns. Do not position for the recovery so aggressively that you get wiped out during the crash. Survival comes first. Opportunity comes second. You need to be psychologically prepared to act when everyone else is panicking. This is harder than it sounds during crashes. The news is terrifying. Every day brings new horrors. Experts predict the end of the financial system. Your portfolio is down 30 or 40 or 50%. Every instinct tells you to sell and preserve what is left. You must ignore those instincts. You must remember that crashes are temporary. You must understand that the best buying opportunities occur at the point of maximum fear. You must have the courage to buy when everyone else is selling. Third, you need to be selective. Not everything that falls during a crash recovers. Some companies fail, some sectors face permanent impairment, some stocks that look cheap are actually value traps. The goal is not to buy everything that is down. The goal is to buy quality assets in sectors with strong recovery potential at prices that offer substantial upside. The three sectors I have outlined, energy, financials, and consumer discretionary, have the best track records of explosive recoveries after crashes. Within each sector, focus on the highest quality companies with the strongest balance sheets and best competitive positions. These are the survivors that will capture the recovery. Fourth, you need to scale into positions over time. You will not catch the exact bottom. Nobody does. The crash may have further to go when you start buying. That is okay. Buy some now. Buy more as prices fall further. Buy more at what you think is the bottom, and buy more on the way up when it becomes clear the recovery has begun. This scaling approach ensures that you deploy capital throughout the crash rather than trying to time the exact bottom. It reduces the risk of being wrong about timing while ensuring you capture the recovery. Fifth, you need to hold through the early recovery. The first stage of the recovery is always met with skepticism. People assume it is a dead cat bounce. They expect prices to fall again. They wait for confirmation that never comes. And by the time they believe the recovery is real, they have missed the most explosive gains. The best returns come in the early recovery when fear is still high and prices are still cheap. If you wait for confirmation, you will buy at much higher prices and generate much lower returns. Trust your analysis, hold your positions, let the recovery unfold. Let me share some thoughts on timing because I know that is what everyone wants to know. I do not know exactly when the crash will come. It could be months away, it could be years away. Timing crashes is notoriously difficult. The market can remain irrational longer than you can remain solvent. As the saying goes, what I do know is that the conditions are in place. Valuations are stretched. Debt is elevated, the economy is showing signs of stress. The triggers for a crash are numerous and unpredictable. It could be a banking crisis, it could be a geopolitical shock. It could be a recession that is deeper than expected. It could be something nobody is currently anticipating. Rather than trying to time the crash exactly, I prefer to position for it gradually, hold more cash than usual, reduce exposure to the most overvalued parts of the market, build watch lists of stocks you want to own in energy, financials, and consumer discretionary. Set target prices at which you would be aggressive buyers. Then wait. When the crash comes, you will know. It will not be subtle. Prices will fall rapidly. Fear will be everywhere. Headlines will be apocalyptic. And that is when you execute. That is when you deploy the cash you have been holding. That is when you buy the stocks on your watch list at the prices you predetermined. The investors who profit most from crashes are not the ones who predict the exact timing. They are the ones who are prepared when the crash arrives. They have cash, they have a plan. They have the psychological readiness to act. Preparation beats prediction. I also want to address what not to do during and after crashes, because avoiding mistakes is as important as making good decisions. Do not use leverage to buy during the crash. Yes, you could amplify your returns, but you could also get wiped out if the crash goes further than you expect. Crashes have a way of exceeding everyone's worst-case scenarios. The margin call that wipes you out comes at the exact moment when the best buying opportunities appear. Stay unleveraged, survive first. Do not buy the most speculative names. The companies that fell 90% because they were trash before the crash will still be trash after the crash. Falling prices do not create value. They just reflect the market's recognition that value was never there. Focus on quality companies that fell because of indiscriminate selling, not because their businesses are fundamentally broken. Do not panic sell during the crash. If you own quality assets going into the crash, hold them. Yes, they will fall. Yes, it will be painful. But selling quality assets at crash prices is how wealth is destroyed. The goal is to add to quality positions during crashes, not liquidate them. Do not wait for the all clear. There is no all clear after crashes. The recovery begins while the news is still bad. Waiting for confirmation that the crash is over means missing the best returns. Act on analysis, not on comfort. Do not put all your capital to work at once. Scale in. Average down, maintain reserves in case prices fall further. The crash may not be a V-shaped bottom. It may be a prolonged period of volatility with multiple false bottoms. Scaling protects you from putting all your money in at the wrong time. Let me conclude with some perspective on what we are really talking about here. Crashes are traumatic events. Real people lose real money. Jobs are lost. Businesses fail. There is genuine economic pain. I do not take any pleasure in predicting crashes or positioning to profit from them. But crashes are also part of how markets work. They are the mechanism by which excesses are corrected, valuations are reset, and resources are reallocated from less productive to more productive uses. They are painful but necessary, and they create opportunities for those who understand them. My approach is to accept that crashes happen, to prepare for them, and to act decisively when they occur. I do not wish for crashes, but I recognize that wishing does not prevent them. They will happen regardless of what anyone wants. The only question is whether you will be prepared. The three sectors I have outlined, energy, financials, and consumer discretionary, represent the best opportunities when the coming crash ends. They are sectors that get destroyed during downturns and explode during recoveries. They are sectors where patient capital can generate extraordinary returns. Study these sectors, build your watch lists, maintain your cash reserves, prepare yourself psychologically for the opportunity that is coming. And when the crash arrives, when fear is at its peak, when everyone is telling you that this time is different and things will never recover, remember what I have told you today: crashes end, recoveries happen, and fortunes are made by those who buy quality assets in recovering sectors at distressed prices. That is how I made my fortune. That is how the great investors have always made their fortunes. And that is how you can make yours when the coming crash creates the opportunity of a generation. But let me go deeper into the specific characteristics I look for in each sector, because the details matter enormously when you are putting real capital at risk. In energy, the biggest mistake investors make is buying the most leveraged exploration and production companies, because they offer the most upside. Yes, if oil goes from $40 to $100, a highly leveraged E&P company might go up 500%. But if oil stays at $40 for 6 months longer than expected, that same company might go bankrupt. You lose everything. The asymmetry is wrong. Instead, I focus on companies with low break-even costs. What price does oil need to be for this company to generate positive free cash flow? If the answer is $60 or $70, I am not interested. I want companies that can survive and profit at $40 or $50. These companies might not generate the biggest percentage returns, but they will survive to generate returns at all. I also look at hedging policies. Smart energy companies hedge a portion of their production when prices are high. This locks in profitability even if prices crash. Companies that are fully exposed to spot prices are gambling. I want companies that manage risk intelligently. Reserve life is another critical factor. How many years of production does this company have based on proven reserves? Companies with short reserve lives need to constantly find new reserves or acquire them. This requires capital, which may not be available during crashes. Companies with long reserve lives can hunker down and wait out the storm. In the midstream space, I focus on contract structures. The best pipeline companies have long-term take or pay contracts where customers must pay regardless of how much product they actually ship. These contracts provide revenue stability even when production volumes decline. Companies with more exposure to spot shipping rates will see revenues fall more dramatically during downturns. For utilities, I look at the regulatory environment. Utilities in states with constructive regulators can earn reasonable returns on invested capital. Utilities in states with hostile regulators face constant pressure on margins. The regulatory environment does not change during crashes, but it determines how quickly utilities can recover and grow after the crash ends. In financials, the details matter even more because leverage amplifies everything. For banks, I start with the capital ratios. Common Equity Tier 1 capital as a percentage of risk, weighted assets is the key metric. Banks with ratios above 12 or 13% can absorb significant loan losses without becoming impaired. Banks with ratios at the regulatory minimum of 7% have no cushion. One bad quarter of losses and they are in trouble. Deposit composition is crucial. Banks funded primarily by sticky retail deposits have stable, low-cost funding. Banks dependent on wholesale funding or uninsured business deposits face run risk. We saw this clearly in 2023 when Silicon Valley Bank and First Republic failed after depositors fled. Look for banks where the majority of deposits are insured and retail in nature. Loan portfolio composition tells you where the risks are. Banks with heavy exposure to commercial real estate, particularly office buildings in struggling cities, face years of elevated losses. Banks focused on residential mortgages to credit-worthy borrowers face much lower risk. Banks with diversified loan books across multiple categories and geographies can absorb losses in one area without catastrophic impact. For insurance companies, reserve adequacy is the key metric. Insurance companies set aside reserves to pay future claims. If reserves are inadequate, the company will have to take charges that reduce earnings and book value. Conservative reserving practices, where companies hold more reserves than they probably need. Indicate management teams that prioritize financial strength over short-term earnings. Investment portfolios matter enormously for insurers. Life insurance companies in particular hold large bond portfolios. When interest rates rose in 2022 and 2023, many insurers had massive unrealized losses on their bond holdings. These losses are not reflected in earnings, but they reduce the true economic value of the company. Look for insurers that have managed interest rate risk prudently. For asset managers, I focus on the mix of assets under management. Equity assets will decline more during crashes than fixed income assets. Alternative assets like private equity and real estate may not mark to market immediately, providing artificial stability but will eventually face write-downs. The mix of assets determines how much fees will decline during the crash and how quickly they will recover. Fee structures also matter. Asset managers charging higher fees on actively managed products have more downside if clients flee to passive products during the crash. Managers with diversified fee streams across active, passive, and alternative products have more stability. In consumer discretionary, the analysis requires understanding the specific dynamics of each subsector. For retailers, e-commerce penetration is critical. Retailers that have successfully integrated online and physical sales will fare better than those still struggling with digital transformation. During crashes, consumers cut back on trips to stores. Retailers that can serve them online maintain relationships and sales. Retailers dependent entirely on physical traffic face steeper declines. Inventory management separates survivors from casualties. Retailers that enter crashes with bloated inventory face massive markdowns to clear product. This destroys margins and can eliminate profitability for quarters. Retailers with lean inventory and flexible supply chains can adjust quickly to lower demand without devastating markdowns. For restaurants, the distinction between fast food and casual dining matters. Fast food tends to hold up better during recessions because it offers an affordable treat when consumers cannot afford more expensive options. Casual dining faces more pressure as consumers eliminate discretionary restaurant visits entirely. Franchise models versus company-owned models also matter. Franchisors collect royalties regardless of unit-level economics. They can survive downturns with limited capital requirements. Companies that own and operate their restaurants bear all the costs and need significant capital to survive extended downturns. For travel companies, balance sheet strength is everything. Travel demand collapses during crashes and recessions. Companies need enough liquidity to survive months or years of reduced demand. The travel companies that survived 2020 had strong balance sheets or were able to raise capital. Those that did not went bankrupt. Within travel, business versus leisure mix matters. Business travel often recovers more slowly than leisure travel because companies implement permanent changes to travel policies during downturns. Companies skewed toward leisure travel may see faster recovery. Let me also discuss some sectors I am avoiding because knowing what not to buy is as important as knowing what to buy. I am avoiding technology companies with no current profits that depend on continued access to capital markets. During crashes, capital markets freeze. Companies that need to raise money to survive cannot access it. They either go bankrupt or have to accept highly dilutive financing. Either way, equity investors are destroyed. I am avoiding real estate investment trusts exposed to office and retail properties. These sectors face structural challenges beyond the cyclical challenges of a crash. Work from home has permanently reduced demand for office space. E-commerce has permanently reduced demand for retail space. These sectors may not recover to previous levels even when the economy recovers. I am avoiding highly leveraged companies in any sector. Leverage kills during crashes. Companies that seemed fine at modest debt levels become distressed when revenues fall, and they cannot service their debt. The survivors in any sector will be the conservatively capitalized companies. I am avoiding companies with concentrated customer bases. If a company depends on a small number of customers, the loss of any one customer during a downturn can be catastrophic. Companies with diversified customer bases can absorb the loss of individual customers without existential impact. Now let me discuss portfolio construction because owning the right stocks is not enough. You need to own them in the right way. Position sizing should reflect conviction and risk. Your highest conviction ideas in the most attractive sectors deserve larger positions. More speculative positions or positions in riskier companies deserve smaller allocations. No single position should be large enough to impair your portfolio if it goes to zero. Diversification within sectors protects against company-specific risk. Even in attractive sectors, individual companies can fail. Owning multiple companies in each sector ensures that the failure of any one company does not eliminate your exposure to the sector's recovery. Cash allocation should increase as crash risk rises. Right now, with conditions in place for a significant downturn, I am holding more cash than usual. This cash will be deployed during the crash to buy quality assets at distressed prices. Holding cash feels painful when markets are rising but proves invaluable when markets crash. Rebalancing during crashes is essential, as some positions fall more than others. Their weights in your portfolio decline. Rebalancing means selling what has held up relatively well and buying what has fallen most. This is psychologically difficult, but mathematically sound. It ensures you are adding to positions at lower prices. Let me also talk about the psychological preparation required, because the emotional challenge of buying during crashes exceeds the intellectual challenge. You need to accept that you will be early. The crash will likely go further than you expect. Positions you buy will show losses before they show gains. This is normal. Being early is different from being wrong. If your analysis is correct, time will prove you right. But you must be able to withstand the interim pain. You need to tune out the noise during crashes. Every headline is negative. Experts predict catastrophe. Friends and family question your sanity for buying while markets collapse. You must be able to ignore all of this and focus on your analysis. The crowd is always most bearish at the bottom. If you follow the crowd, you will sell at the bottom rather than buy. You need to have a plan and stick to it. Before the crash, decide what you will buy and at what prices. Write it down. When the crash comes and emotions are running high, execute the plan mechanically. Do not second-guess yourself. Do not wait for better prices. Do not convince yourself that this time really is different. You need to remember that volatility is not risk. Prices falling is not the same as permanent loss of capital. If you own quality companies that will survive the crash, falling prices simply mean your future returns will be higher. Volatility is the friend of the long-term investor. It creates opportunities. Embrace it rather than fear it. Finally, let me leave you with some perspective on what we are really preparing for. Crashes feel like the end of the world when you are living through them. I remember 2008 vividly. I remember watching the financial system teeter on the brink. I remember the fear that everything I had built would be destroyed. It was terrifying. But the world did not end. The financial system did not collapse. The economy recovered. Markets recovered. And investors who bought during the panic made fortunes. The same will be true of the coming crash. It will feel terrible while it is happening. The news will be relentlessly negative. Prices will fall further than anyone expects. It will be tempting to sell everything and hide in cash, but the world will not end. The economy will recover. Markets will recover. And the investors who bought quality assets in energy, financials, and consumer discretionary at distressed prices will make fortunes. That is the opportunity I am preparing for. That is the opportunity I am encouraging you to prepare for. It requires patience to wait for the crash. It requires courage to buy during the crash. It requires discipline to hold through the early recovery. But the rewards for those who can do all three will be substantial. The crash is coming. The opportunity is coming. The question is whether you will be prepared to seize it. I know I will be. I hope you will be too.